Okay, so we are live. Okay, so we have some people here. Let's see. Hello to those of you that are here. If you can hear me, just drop a comment in the chat, just to make sure that you can hear me. Nibia, can you see the chat?
Yes.
You see the chat? Okay.
Mm-hmm.
All right. So for those of you that are joining, hello, 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 hello. Okay. So just let me know that if you can hear me, just say yes, I can hear you, or say something. Okay, wonderful. Okay, so that's good. Good to know.
But I'm not seeing any responses though.
Oh, I can see responses here. Hmm.
Okay, I'm seeing it now.
Maybe I'm the only one that can see it. Okay.
Okay.
Hold on, let me see. How do I do this so that you can see? Uh, Private chats. All right, so for those of you that are joining, we're going to start shortly. So thank you for joining. Settings. Okay, so welcome for those of you that are just joining. Okay, so welcome. So we're gonna start in less than a minute. Okay. Okay, all right. So good evening, everyone. I think we're gonna get started so that we can let all of you out of here by 6 o'clock, hopefully. So just a few quick housekeeping things. We're going to get started. There's going to be a lot of information, but don't get overwhelmed. Hopefully, you will have some time later to review them. We're going to leave some time at the end for questions. So if you have questions, what I suggest you do, get a pen, get a piece of paper, just write down your questions and put them in the chat as well. So later we can take those questions at the end of our presentation. So let's start with quick introduction. For those of you that don't know me, my name is Ken Green. I'm the partner here at GMS Professional, GMS Chartered Professional, Chartered Accountants. What do we call it? I don't know. Chartered Professional Accountants. So we run a CPA firm here. We do taxes, we do accounting, we do audits for not-for-profit organizations. And so we're just about to begin the tax season for personal taxes. And that's one reason we have this presentation today. Next week, we're going to have a similar presentation but for corporate taxes. And we're going to share that date at the end of the presentation with you today. I have with me here Nibia. So Nibia is our team lead for financial reporting, and she is going to be doing this presentation with me today. So we're just going to jump right in. In terms of our goals for today, we're going to highlight some personal tax foundational items that I think is important for you to know. So we believe in education. I think if you're educated and you know what to do, you can ask the right questions if you have other people preparing your taxes. So we'll go through some of those foundational concepts. Maybe I will walk us through some of the new things for the 2025 personal tax filing season. Um, and then I will come back and go through some tax planning tips. And then I will share some resources and information on how you can get a hold of us uh, going forward. Okay. Again, if you have questions, yeah, I encourage you to put them in the chat and then we can take a look at them later. Okay. So, personal tax foundation. So, what is the basis of tax in Canada? So for those of you that are not familiar with the basis of tax in Canada, our tax system in Canada is based on residency. So if you're a resident in Canada for tax purposes, then you have to file your tax return and you have to pay tax on your worldwide income. Okay, so our tax system is based on residency. In the US and in a few other places in the world, it's based on citizenship. So that is different. In Canada, it's based on residency. So if you reside here, then you have to pay taxes. We also have what we call the marginal tax rate system. What that means is as your income increases, your tax rate also increases. Okay? And so that's the marginal rate tax system. And I'm going to walk you through a table that shows those marginal rates. The higher you make, the more taxes you pay on every additional dollar that you make. Okay, so that's what our marginal rate system is. In terms of our rates, so these are the 2025 combined Ontario and federal tax rates. Obviously, if you live in a different province other than Ontario, your rates are going to be slightly different, but are very similar to this. Okay. So here you'll find that if you earn less than $16,000 federally, you'll likely pay zero taxes. In Ontario, the personal tax credit that we have is 12,747. Now, that tax credit you see on the federal side is 16,453. Again, that will reduce based on your income threshold. Okay, so the higher amount of income you make, you may have to pay your personal tax credit or tax amount will reduce. So if you're looking at this rate, you see that if you have $52,000, 886,000, then you're going to pay 19.55% on that income, and then it continues to increase up to 53.53%. Okay, so if you make anything above 253,414, your tax rate on any income higher than that amount is going to be 53.53%. Okay, and so later we're going to talk about how you plan based on these marginal tax rates. So it's important you understand these rates because that's going to help you as you begin to plan using your marginal tax rates. How do we calculate our personal taxes, right? So if you work in Ontario in Canada here, if you make any sort of income, right? So you have your income, you are allowed to deduct certain amounts from your income. Okay, so let's say I work for a corporation and I make $100,000 a year. There are certain deductions I can take to reduce my gross salary to my taxable salary. Okay, and those are deductions that I can take. Examples may be things like registered retirement savings accounts. Okay, childcare expenses. So there are a few things I can deduct against my income to arrive at my taxable income. And then once I have my taxable income, my tax rate will now apply. Again, those marginal tax rates will apply based on the different brackets. And then once those tax rates apply, I'm going to have my taxes payable. Once I have my taxes payable, I can now further reduce the amount of taxes I owe with what we call tax credits. So tax credit is a dollar for dollar refund of the taxes that I owe. So those tax credits will reduce any tax amount I owe for me to now arrive at my tax liability. Okay, so first you have your gross income. You can reduce that gross income with deductions to arrive at your taxable income. And once you have your taxable income, we'll apply the rates to calculate the amount of taxes you owe. And then based on that, you can now reduce those taxes with credits to arrive at your tax liability. Okay, so that's a simple overview of how your personal tax liability is calculated. The other point I want you to know is that not all income is taxed alike. Okay, so we live in a country where certain types of income are taxed at a slightly higher rate compared to other types of income. So very important to know that, and this is a table that illustrates that. So let's say, for example, you are at the top marginal tax rate. So I showed you earlier the tax brackets. So let's say you're making $300,000 a year. Okay. So any additional dollar you make above that, so let's say, for example, $10,000 in this case, if you have ordinary income, things like salaries, maybe you're withdrawing money from your RRSPs or getting retirement income, you're getting interest from your investments, okay? All of this income will be taxed at 53.53%, okay? So if $10,000 is the income, your after-tax money left after the taxes is taken, in this case, in the first example, is 4,647. Okay. Now, what if you make capital gains? Okay. So for those of you who don't know what capital gains is gains on your capital assets. So let's say I buy stocks and I hold it for 1 year, 2 years, and I turn around and I sell it. My gain is a capital gain. Okay. If I have a rental property, I turn around and sell it. That gain is a capital gain. So because of the the fact that the inclusion rate is only 50%, the tax rate is lower. So for capital gains, that tax rate is 26.76%. So now on the same $10,000, my after-tax cash flow is now 7,324. Okay. What if you have eligible Canadian dividends? So if you invest in Royal Bank, CIBC, uh, any of these big Canadian corporations, and you get dividends, those dividends are taxed at 39.34%. And so with eligible Canadian dividends, you're going to have after cash flow of 6,066. With ineligible Canadian dividends, so let's say you invest in a private corporation like my business, those dividends are not eligible. So those tax rates on those dividends are slightly higher, and now you're okay. If you're getting return on capital, so for those of you that invest in mutual funds, maybe you invest in a business or you even take a loan. So when you get your capital back or when you take a loan, you don't pay any taxes on that, right? And so that's something that you get tax free. Okay, so having a good understanding of this can sometimes inform how you invest, inform the type of income you generate, because understanding the different tax implications for the different types of income can become a very, very important tax planning tool. Okay, so it's very important to understand that not all income are taxed alike. Okay, so tax credits and tax deductions. I talked about this briefly. Deductions will reduce your gross income to your taxable income. And tax credits is a dollar for dollar refund that will help reduce the amount of tax that you owe. Another confusing term is tax deferred and tax free. Oftentimes people think it's the same thing. Okay, tax deferred simply means that you owe the tax, but you're just not paying it today. You're paying it sometime in the future. Okay, tax free means you don't owe the taxes at all. Okay, so when I think of two good examples, RRSP, Registered Retirement Savings Plan, is an example. You don't pay the taxes today, you pay it sometime in the future when you withdraw from that account. On the other hand, TFSA is an example of a tax-free account because anything you have in your TFSA grows tax-free. You don't owe the taxes today, and you never owe the taxes in the future when you withdraw. Okay, so those are the two key differences between tax deferred and tax free. Now I'm going to pass it on to Nibia to go through some of the updates for this tax season. So Nibia, the email
Mm-hmm.
ad, so let me add it. Okay, so you can proceed, Nibia.
Okay. So there's not much changes for this tax season. Really, the biggest one is the middle class tax cut, and this is where the government has reduced the rate for the lowest income tax bracket from 15 to 14%. So this is on income up to 57,375. But because they did that in the mid of 2025, so for 2025 tax year, we'll only get 14.5%, but for 26 onwards, we'll get the full 14% reduction. So individuals filing their taxes are looking at a saving of up to $286, and then for family of two, your savings could be up to $572. So because of this rate cut, so this also affects the top up tax credit. And sorry, this also affect our non-refundable tax credits that we get because the federal rate tax rate on the first tax bracket dropped from 14 to 15%. Non-refundable tax credits are calculated using this rate. So some individuals with large non-refundable tax credits could see a decline in the value of these credits if you have large. So what the government did, they came in and introduced a top-up tax credit to ensure that they don't lose value. So effectively keeping it at around 15% credit rate on portions above the first tax bracket threshold. And this is only from 2025 to 2020 to 2030 tax years. But not everyone will get this benefit. It's only those who have unusually large non-refundable tax credit amounts will see the benefit of this. So for the digital news subscription tax credit, I think this came about in around 2020 or 2021. However, it's no longer applicable for 2025 tax year, so we won't get this credit anymore. So for Canada, so both CPP and EI, so the rates, so CPP rate remain the same. However, the the bracket or your income that it's applied to has increased to 74,600. That's up from 68,500. So what this basically means is that for 2025 tax year, 2026 tax year, we're gonna pay more in CPP if our income is above 74,600. Also to that, we have the second CPP tax rate as well. So that will slightly increase as well if our income is above 85,000 for the year. Similarly with EI, the EI rate has decreased by 1%. However, they have increased the maximum insurable earnings from 65,700 up to 68,900. So essentially, we're going to pay more in AI if our income is above 68,900. For charitable donations, so last year, because of the Canada Post strike, for 2024 tax year, we're able to claim donations we made up to February 28, 2025. That's no longer applicable for 2025 tax year. And what we have to be careful about is to ensure that whatever donations we made between January 2025 and February 28, 2025, if we claim those in our 2024 tax return, we cannot claim them in our 2025 tax return. And donations is one area that CRA loves to review. So for this year, we didn't get that extension. So our donation, charitable donation cutoff is December 31st, 2025. So for the Canada carbon rebate, basically, so I think a lot of us will know about this because they reduced the pollution pricing at the gas pump from around March of 2025. The carbon rebate, they are practically stopping that because that was as a result of the increase in the pricing at the pump. So now, because that stopped, they're stopping the carbon rebate. So for persons who are behind in filing their tax return, they are giving us an extension up to October 30th, 2026. After that, we can get a rebate payments no more if you file your tax return late. And then, so the Canada Groceries and Essential Benefit, this is just a one-time top-up payment. And it's related to the GST HST credit value. It's expected to be around mid of 2026 that they give this out to individuals. So for medical expenses tax credit, more so in regards to fertility treatment. So this is not new federally. It's been about since around 2022. However, Ontario came in with some new proposal for 2025 or implemented this for 2025 tax year. So basically, now they've made some fertility expenses eligible to be claimed as medical expense tax credits. And of course, your fertility, the clinic or donor bank has to be in Canada. It shouldn't be outside. If it's outside, there are some criteria that has to be met. But for Ontario, they are giving persons a 25 credit and eligible expenses up to $20,000, up to a maximum of $5,000. And of course, we know that fertility treatment costs can be very expensive. So if this applies to any of you, that'll be a good advantage to take. The home accessibility tax credit. So basically what persons were doing before, persons who have eligible home accessible tax credit expenses, they were claiming them both for home accessible tax credit as well as medical expenses tax credit. So for 2026 tax year and beyond, the government is cutting that out. So no more double dipping in regards to that. So the government has expanded the list for the disability support deductions. So they have expanded some more expenses that we can claim for disability support deductions. For the student loan forgiveness program, so they have also extended in 2026. So for 2025 and 2026, the Canada Student Loan Forgiveness Program, it has undergone significant expansion, basically, where in terms of both workers who qualify and the geographical areas where they can work, basically. So they have increased the list of occupations who qualify to get this loan forgiveness However, you gotta be working in certain areas, right? So, family doctor, dentist, pharmacist, psychologist, they can get around $60,000 over the 5 years in forgiveness. And then you have other professions like registered nurse, midwives, teachers, social workers can get around $30,000. And then like dental hygienists, personal support workers can get around $15,000 over the 5 years. But you gotta be working in underserved rural remote community areas to qualify for this. And if you need any more information on these, we have put a hyperlink in the slides that we will share with you once the presentation is done. The personal support worker credit, this is something that they introduced in 2025. However, it won't be applicable or we can claim it until 2026 tax year. So, but what this is about is the, sorry. So what the government has done is to basically show appreciation to personal support workers, where they're giving them a 5% credit on eligible earnings, and where they can get a maximum credit of up to $1,100. So whether or not they have a refund, they can get this refund basically. To qualify, they must have ordinary provide one-on-one care, and they must be an eligible worker employed to an eligible establishment, and earnings and employee earnings must be certified by the employer. So there is going to be a form that the employer has to fill out for them to get that credit. Ontario in 2025 has introduced where they're given a full 8% of the HST portion. So basically the provincial portion of the HST, they're giving that back to first-time home buyers. So if you're buying a house up to $1 million, they'll give you back the full 8%. However, up to $1.35 million, they'll gradually reduce that amount down to $24,000. If you buy a house over $1.35 million, then the maximum you can get is $24,000. But that'll be good for first-time home buyers. For 2026, the maximum RSP that contribution that you can do is 33,810. This is up from 32,490. However, we have to bear in mind that it's the lesser of 18% of our income and the 33,810, right? And again, the deadline to contribute to our RSP that we can claim for 2025 tax year is March 2nd of this year. Also, the TFSA dollar limit for 2025 and 2026 hasn't changed. It's still 7,000. However, our contribution limit has grown by that extra 1,000. So it's now 109,000, up from 102,000 in 2025. So CRA is transitioning to purely online communication. So if you notice in mid of last year, if we usually get certain mails from them, like source deduction mails and other mails, you'll notice you no longer get those because they have transitioned everything online. And in order to get those mails again, you'd have to call them and ask them to send it to you, but they only limit the amount that they send as well, because they're trying to get everyone online. So what this means, it's good for both persons and businesses to have their My CRA account set up, and not just have it set up, but have an email address linked to it. So when the CRA uploads any new information to that account, they'll get the notification. Also, what the CRA is doing is that they're finding persons who has repeatedly filed incorrect income exceeding $500 within the last four tax returns that they have filed, basically. So what this means for us is that if we're before we file our tax returns, just ensure that we have all the slips from all the different institutions that we have done business with for the tax year. Because if not, even though it's a genuine mistake when you leave out a slip, sometimes the CRA doesn't have that slip either. However, when they do get that slip, they will review your taxes and they will fine you that penalty. So important dates for this tax season. The deadline for personal taxes is the usual April 30th. If you owe CRA any money, that's the deadline as well. After that, you'll have to pay penalty and interest. If you're a sole proprietor, the deadline for payment is still April 30th, but you have until June 15th to file your taxes as well as any HST return. Similarly, the deadline for payment for HST owing is the 30th of April. However, you have until the 15th of June to file your taxes. So Ken will take over again with the tax tips and planning.
All right, thank you so much. And yeah, I just want to make sure that everybody can hear me clearly. And I saw some comments in the chat about my audio. So just make sure, let me know if you can hear me very clearly. Now we can switch gear to some tax planning ideas that you need to consider. So what is tax planning? I think it's important for us to start with this definition here. What is tax planning and why is it important? So the way I define tax planning is an intentional tax efficient plan designed to minimize or eliminate taxes, okay? So we're not here, our goal is not to cheat or not to pay taxes at all, but our goal is to make sure we don't pay more than we need to pay, okay? So when we look at our taxes, we want to be able to save money tax-free or at least do it tax efficiently. We want to be able to allow that money to grow tax-free or tax efficiently. And finally, when it's time for us to start withdrawing or distributing those funds, we want to be able to do that as well, tax-free or tax efficiently. So the first tip is to get organized. Okay, so when it comes to filing your taxes, it's important to put some systems in place, whether you organize your documents electronically or you do it on paper. It's important to have folders and to have different folders set up either in your file cabinets or electronically to make sure that you have all your documents. I also encourage you to file on time. Okay, I know the tax filing season is now open, but as Nibia mentioned earlier, it's possible that you may not have all your slips yet, okay? The slips to file or the T5s and T4 is going to be end of this month. And then if you're expecting anything like a partnership income or T3 from a trust, then the deadline for filing is March 31st, okay? So if you think you're expecting additional slips, I encourage you to wait and file maybe first week in April. But if you think you have all your documents, you can start filing now or sometime next month in March, okay? But it's always important to file on time, obviously before or certainly before the deadline of April 31st, April 30th. You also want to file on time to avoid penalties, okay? So the interest rate right now is 7%. So CRA will update this interest quarterly. Right now it's 7%, okay? And these interests accrue every day, essentially. You also want to file, and one of the reasons you want to stay organized is because you want to avoid reviews, you want to avoid audits, and you want to avoid unnecessary reassessments. Okay. Sometimes you may not avoid things like the random reviews that are done by CRA, but if you have all your documents organized, it makes it a lot easier to respond to those reviews. Okay, so but always know that it's important to stay organized to avoid some of these things from CRAs. So deductions, I talked about deductions earlier. As I mentioned, deductions will reduce your taxable income. Okay, and I've listed some examples of deductions here, some of the very popular ones like RRSP. If you have someone with disability, the registered disability savings plan, the new account that was created a few years ago, the first home savings account. You may have things like union dues, childcare expenses, moving expenses, support payments. All of these things are important if you have them, never to forget your deductions. Okay, oftentimes I see clients that forget deductions over and over again. Okay, so just remember the things you can deduct. An easy one that people often forget is carrying charges and interest. Okay, remember if you borrow money to invest or if you borrow money to put in your business, then the interest you pay on that borrowed fund, you can deduct it and use it to reduce your taxes. Okay, if you own a business and you're running at a loss, that can be a deduction against your income. If you have rental property, again, if you're running a loss with rental property, obviously not the depreciation you take on your rental property, that loss again can be used to offset income from your personal taxes. Okay, if you have vehicles that you use for to earn income, that can be deducted as part of your tax return. Okay, in general, if you have expenses that is directly incurred to earn income, remember that you can deduct those. Obviously, if you're an employee, then you need to get the T2200 from your employer that will allow you to deduct certain expenses. Okay, so very, very important to pay attention to some of these items. I talked about credits as well earlier. So credits will reduce your taxes payable. So it's a dollar for dollar offset on the taxes that you've calculated that you're owing. Now you can reduce those with credits. And so we have some examples here. Things like donation credits are the very popular ones, right? Donation credit, medical credits. If you're buying your home for the first time, you have the first time home buyer's credit. The renovation credit that is now available that you can use, disability tax credit. So remember, all these credits can be used again to offset some of the taxes that you may be owing on your tax return. Um, Now, some of these deductions and credits are also based on income or expenses. Okay, so in this chart here, I've just highlighted a few of them. Okay, if you qualify for adoption expenses, okay, so let's say you need to adopt a child, all those expenses you incurred to adopt a child, 14% of those expenses, up to a maximum of 19,972, uh, can be used to reduce your taxable income. Okay. We talked about charitable donations. Okay, so 14% of the credit for the first 200. As you donate more and more, those credits begin to increase up to 33%. We talked about the home accessibility credit, okay, up to 40% up to a maximum of $20,000 in expenses. The lifetime capital gains exemption, okay, so this is something that is available to those that own shares in qualified small business corporations. Again, they can claim up to 1.2 million to reduce capital gains from disposition of those shares. We also have medical expenses. Okay, again, up to income over 3% of your net income. Okay, so all these credits, always remember that you qualify for them. If you qualify for them, remember to use them and just have in mind that some of these credits are tied to income and expenses. And now this chart here is just a quick illustration of the value of tax deductions or tax credits. Okay, so in this example, I'm just assuming that you're making $100,000. Okay, so if you're making $100,000 and you don't have deduction or credit, if we apply the tax rates, right, based on the marginal tax rates, you're looking at a total tax of $20,470. Okay, but let's say you make an RRSP contribution of $5,000. Okay, so that RSP contribution of $5,000 can reduce your total income to a taxable income of $95,000. Now your taxes will now reduce from 20,470 to 18,926. Okay, so resulting in a tax saving of 1,544. Okay, now what if you have a credit, a tax credit of $5,000? So remember, the government has reestablished with the top up now, they've reestablished this credit at 15%. So if we take 15% of $5,000, so that's 750. Now that 750, we can now use that to offset part of that 20,470 that we're owing. And so we're actually getting a direct savings of $750 in terms of taxes. Okay. So this is just to show the importance of tax deductions and tax credits. If you qualify for those, always remember to include those when you're filing your tax returns. Um, so these are some other tips. So use your TFSA to grow your money tax free. So remember one of those three things we talked about when you're planning for taxes. You want to save tax free, you want to be able to grow the money tax free, you want to be able to distribute it tax free or tax efficiently. With TFSA, even though you contribute with after tax dollars, that money grows tax free. Okay, so I always encourage you to use your TFSA. Particularly if you've not been contributing to your TFSA. So let's say you're in a lower marginal tax rate. I think it's even better for you to contribute to your TFSA than to contribute to your RRSPs. Okay. If you're in a very high top marginal tax rate, I will say first, maximize your RRSP deductions. And then if you have any additional cash, you can now use and put that towards your TFSA. Maximize your RSP contributions. We'll talk about this before. Okay, always important because that gives you a tax deduction right away. Okay, if you can contribute to your RRSP. In this chart here, I just show a quick summary of the differences between a TFSA and RRSP. Okay, so with the TFSA, contributions are not tax deductible. Okay, so you contribute your after-tax dollars, but with the RRSP, anything you contribute will automatically or immediately reduce your taxable income. Okay, withdrawals for TFSA, they are not included in income, they are tax-free. Okay, and they're tax-free forever. On the other hand, with RRSPs, when you withdraw, that income is fully taxed. Okay, in terms of minimum age, with TFSA, you have to be at least 18 to open a TFSA account. That does not apply with an RRSP. And in terms of maximum age, there's really no restriction with TFSA. With the RRSP, you must close your account by December 31st, the year you turn 71. So oftentimes, the RRSP's account, we roll into what we call the retirement income account, okay, RRIF, okay, the retirement income fund account, okay. So that's just on a high level the differences between TFSA and RRSP. Another way to minimize taxes is to start a business on the side, okay. So what are some of the benefits of starting a business on the side? Okay, so if you have a passion, you can convert that passion into a business. Okay, so that business may help you convert some of your after-tax expenses to before-tax expenses. And in addition to that, if you make losses in the first couple of years running your business, those losses can also offset income from other sources when you file your taxes. Where possible, income split with family members. Okay, so this is more relevant for someone that has a business. Or if you earn pension income, you can also income split your pension. Okay, there may be other strategies where you can income split by moving or advancing loan to your spouse that is in a lower income bracket so that they can invest and earn income that generates income in their hands that will be taxed at a lower rate. If you have family members, kids, and you run a business, you can always get them involved in your business and pay them a reasonable salary for working in your business. And that can be a way to income split with family members. Where possible, if you have um, securities, if you have investments in a non-registered account with very high unrealized gains, you can consider donating those securities directly to a registered charity. Because what will happen is that the fair market value, you get a receipt for the fair market value, okay, even though your cost is minimal or small. And so that receipt becomes a huge donation that can give you donation credit to help offset some of your taxes. The other one, if you live in Canada, you know that we have this thing called principal residence exemption. Okay. So that's why I say, well, if you don't have a home, I think you should get one as soon as possible. I know if you live in places like Ontario or BC, I know it's expensive to buy, particularly in this market. But those of you, I think some of you know that the real estate market is also softening in some parts of the country. So this may be a good time to get into real estate, right? So the principal residence exemption is a huge benefit. Remember, when you sell your principal residence, you pay zero taxes. Okay, if you live in your home and you own it, every year you're building equity. That equity becomes a way you can leverage and take that money to buy more real estate or to invest in a business or to invest in other things. And when you leverage, that interest you pay on that amount becomes tax deductible. Okay, and for those of you that don't know, leverage is one of the ways you build wealth quickly and you build it tax efficiently. Okay, so when you buy real estate and you own real estate, you're not only getting a place to live, you're you're bypassing taxes, you're you're using or you're building equity that allows you to leverage, equity that allows you to continue to invest and to buy more homes. Okay, and you know that over the long term, the prices of house continues to grow, continue to increase. Okay. Yeah, just the same thing. In addition to that, once you're able to get your own home, you can now leverage that into other rental properties. Okay, so when you buy other properties, automatically you're now in the business of managing rental properties. And now you're opening yourself to additional deductions because now you run a business. You have additional business write-offs, additional leverage, long-term growth, and you become a little bit more tax efficient in the way you grow your wealth and grow your income. So this is something I've not talked about before, but I think I want to highlight it and highlight it today because now we're beginning to see more and more returns of individuals that are now deceased. Okay, so it is important to plan for death. I know we don't want to die, but we know that is also inevitable. Okay, so it's very, very important to plan for these things. Some of you may have read that news, I believe it was last year, when the parents of this individual, they died almost in quick successions. The dad passed away, then not too long within the same year, the mom also passed away, and they were left with over $500,000 in a tax bill to pay for their parents' estates. Okay, so that can happen, right? And so, how do you plan around those things? So to do that, I just want to go through some key tax implications on death. Okay, if you die and you own capital assets, those assets are deemed to be disposed at their fair market value. Okay, so what that means is if you have an asset that you bought for $1 and is now $1 million, when you die, you're going to pay taxes of $1 million. Okay, $1 million will be added to your final tax return, and now you'll be required to pay that tax. So just imagine that you are leaving this estate to your kids, And now they have to deal with maybe $300,000 or $400,000 in taxes to pay. And where do you think they're going to find that money? Okay, they would now be forced to sell property or to sell assets to be able to cover those taxes. Okay, so deemed disposition at fair market value, and this can result in a large tax bill. If you have a surviving spouse, the taxes can be deferred, right? Because these assets can automatically roll over to your surviving spouse, except, of course, you elect out of that rollover. If you elect out of that rollover, then now you have to pay the taxes. And sometimes there are tax benefits to file that election. Again, that requires some tax planning. There may be a reason to file the election. But oftentimes, if you have a surviving spouse, those assets can roll over to the surviving spouse tax-free. Now, when someone passes, in addition to the final terminal return that has to be filed, there are other three possible tax returns that can be filed. Okay, so this is very important because now these additional tax returns can be used as tax planning tools. Okay, so now we can decide, okay, should we file one return? Should we file two? Should we file multiple returns? Because with some of these returns, you can actually duplicate some of the tax credits. Okay, so important to know that when someone passes, in addition to the final tax return, there may be other additional returns that they may be entitled to file. Now, what about personal tax credits? As I mentioned before, with those additional tax returns, there are certain non-refundable tax credits that can be multiplied. In other words, we can claim it on one return, claim it on the second one, claim it on the third one. Okay? Medical expenses. Okay? Remember, with us as individuals that are still living, medical expenses will have a 12-month period, right, that we can use. But for someone that is deceased, that is now expanded to 24 months. Okay, and then there is also favorable treatment for donations. Okay, when certain conditions are met, because some of these donations you can carry them forward for multiple years. Okay, CPP tax benefits. Okay, so everybody that passes away gets a death benefit from the government. I believe it's 2,500. Okay, so those death benefits are not taxable to the deceased. The benefits are taxable in their estate or maybe in the hands of the beneficiary. Capital losses carry forward. So this one is very, very important. Okay, and this can be a significant planning tool. Okay, so remember, ordinarily with capital losses carry forward, those can only be applied against capital gains. But for a deceased taxpayer, those net capital losses can be applied against all sources of income. Okay, so this can be very, very significant when it comes to planning considerations. The fact that you can offset your capital losses with any other income or income from other sources. Okay, again, important information to know. With RRSPs, again, the fair market value of the RRSPs is deemed to be received immediately before death. So what that means is if I pass away today and I have $1 million in my RRSP, then my tax return will report income of $1 million. That can be significant when it comes to taxes. Okay. And if you have a spouse, on the other hand, that RSP can transfer to the spouse tax-free, and the spouse can also roll that RSP into their own account. With TFSAs, upon death, the TFSA ceases to exist. Okay? All properties, all the TFSA, all the assets will be deemed to be disposed. But again, because it's tax-free, there are no taxes. Okay? On the hands of the deceased. Now, the beneficiaries may have to pay taxes on any additional income, okay, that grows from that RRSP funds. Again, if you have a surviving spouse, the RRSP assets again can be transferred to the surviving spouse RRSP account, TFSA account again. But remember that designation has to be made in your TFSA account to allow that transfer. And once that transfer is done, it doesn't impact your surviving spouse's contribution rule. Clearance certificates, again, very, very important. So let's say you are the administrator or the trustee handling the estate of a deceased person. It's very, very important that you obtain a clearance certificate from CRA before you distribute the assets. Okay, the clearance certificate simply says a CRA telling you that, well, we've assessed all the tax returns filed for the deceased person. We can now conclude that the deceased person owes no taxes. Because if you don't do this, if you're the legal representative or the trustee for that estate, you may be legally liable for any taxes that are owing if you go ahead and distribute before you get the clearance certificates. Okay, so very, very important reminder here to make sure you get those certificates before you distribute assets. Now, some additional tips. If you're an employee, remember you can negotiate some of the terms of your employment. And if you click on that link, I discuss 7 ways you can lower your taxes as an employee when you bring up some of those ideas to your employer. Some of you are aware of this account called First Home Savings Account. Again, you can contribute up to $8,000 per year, up to a maximum of $40,000. Again, this account combines the benefits of the TFSA and RRSP. Okay, you get a deduction when you take the money to buy the house. You don't pay any taxes at all. Okay, so very, very important if you've not bought your home to set up an account like this. You can also use your home buyers plan, now $60,000, and now they've expanded it to 15 years payback period. It used to be 10 years in the past, but now you can pay back over a 15-year period. Okay, so now with the FHSA and home buyers plan, you can now have access to like 100 grand that you can put down towards your down payment to buy your home. And I talked about the marginal tax bracket before. So this is an idea you can use to plan your taxes. So if you see that you're in the top bracket, what can you do, for example, to bring yourself down to the next lower marginal rate bracket, so that way you save a little bit in taxes. Okay, so there are a few things you can plan around those. Okay. Obviously, if you want us to support you, we can help you in a different ways. If you file your own taxes, you can engage us to review your taxes. Okay, so that's something we can do. That's a service we offer. You can engage us to review your taxes either before you file or even after you file. Okay, and so once you engage us with this service, we'll review your taxes. We provide you some comments, provide you some planning ideas, and we even document it so that way you can assess it at a later point. Okay. Obviously, if you want us to do your taxes for you, we can do that for you. Our current rate is $290 for a basic tax return. Obviously, if you have additional complications like rental income, business income, or some other additional complications, obviously you're going to be paid more, but that's just the minimum basic rate. Uh, if you want to go further with planning, if you're looking to build wealth tax efficiently, if you're looking to have someone on your side all through the year, we have this plan that we offer for $1,975, where we meet every quarter and will help you achieve your goals. We also file your tax return for you, and we also deal with any additional questions CRA may have all through the year. Okay, it's a 1-year contract, and we have this, and we have a few clients that like to engage with us in this way. Okay, so these are the 3 ways we can support you if you have personal tax matters. And if you go to this link, you can see more details on this. Now, note this link that we have still has our 2025 rates. But I think by over the weekend, I'm going to be updating those rates to our new rates. But what will happen is if you want to take advantage of the old rates that we have there, I encourage you to send me an email between now and Monday, because after Monday, the new rates will apply. But if you go to that link and you want to take advantage of those low rates, just send me an email directly. Let me know that you want to engage us for any of the services, and we can honor those rates that are currently on our website today. I've provided some resources here. For those of you that know, I wrote a book called Tax Efficient Wealth. So this book is very helpful when you want to get a basic understanding of our tax system in Canada, and if you want to get a blueprint on how you can plan and build wealth tax efficiently. And so if you click on that link, you can get a free e-copy of the book. And here we've provided some additional links. So the first one there is the link that shows all the deductions and credits. We talked about some of the deductions and credits. I encourage you to click on that link to see which one may apply to you. Obviously, if you're a client, we'll walk you through our questionnaire that may highlight some of the things that you may qualify for. Um, this is a crazy time for scams, CRA scams, so it's important you recognize those scams. So click on those links. We have the links there on the interest. And if you're looking to file your tax return and you're looking to do it free, CRA does offer free tax clinics. And there is this Simplify services that you can also use to file your tax return for free. I recommend this if you know that your tax situation is very simple. Okay, if your tax situation is simple, obviously take advantage of the free services. If you think there are some complications that those free services may not be able to provide to you, then obviously talk to us and we can certainly help you. So this is the full tax rate, and this also has the 2025 rates as well as the 2026 rates. So you can take this. You can also go to this website called taxtips.ca. They do provide a lot of comments on tax planning, tax ideas, as well as the tax tables. And if you want to get in touch with us, we do have a YouTube channel. We do have a few videos here. And every year we say we're going to post more videos, but we've not been able to keep up. But if you go there, you'll find some useful videos that you can watch. Obviously, if you go to our website, you can see the list of services that we offer. And if you want to stay up to date regularly, I post regularly on Instagram, on LinkedIn. Again, check those out and connect with me on those platforms if you want to stay up to date on things that are ongoing. Again, feel free to reach out to me or to Nibia directly for personal taxes, and we can deal with all your personal taxes. And as I mentioned earlier, we have another webinar like this for corporations. So if you run a business and you have a corporation, I encourage you to join us here next week. I believe it's March the 5th. I think it's on Thursday. Let me just confirm. Yeah, Thursday, March the 5th. We're going to be here, and those links will be going out again shortly this week for those of you that may be interested. If you own a business, consider joining us next week for corporate tax planning tips. Okay, so I think that is all we have today. I'm going to go and check the chat to see if you have any questions. If you have any questions, let us know, and then we can answer those questions. So let me just check here to see. So I see a question here. For remote work, which is better, to use T22 or to use the general claim? Nibia, do you want to answer this? I think you're on mute, so we can hear you.
Oh, sorry. I'm saying Mubin already answered it. So we're saying
Okay.
for as of 2024 and beyond, we have to use the T2200 from your employer if you want to claim work from home expenses.
That's right. So everybody needs that to be able to claim work from home expenses. Okay, so I have this. So this is from Mohammed. So Mohammed is saying, I did my tax return last couple of years. My own using What's Simple. This year, I bought a home and we withdrew TFSA, RSP. Okay, so now your situation is not that overly complex. Okay, so when you buy your home for the first time, the most important thing to remember is that you get your first home buyer's credit. So don't forget that. You need to be able to claim that. If you withdraw money from your RRSP, make sure you watch out for your withdrawal slip for the RRSP, because that you have to report in income. For TFSA and for FHSA, there are no tax implications in the tax returns. You just have to be mindful of your contribution rooms for those. Maybe I don't know if there's anything else to add. There's a,
No, just no.
okay. So if you have any questions, put it in the chat. So I have one here from Timmy. Timmy says, I have a bunch of questions, please. Number one, can you turn sole proprietorship to a corporation and file expenses from sole proprietorship for tax purposes? Okay. Yes, you can. So if you have a sole proprietorship and you actually have assets, you can roll those assets tax-free to a corporation. But that has to be done on a tax-free basis. So there has to be a form that we can file for you with CRA. So if you're running a business in your sole proprietorship and you want to transition to a corporation, let us know so we can help you. Because if you don't do it properly, CRA can deem that you've sold all your assets and you now have to pay taxes on all the proceeds. Okay, so that's what will happen on the worst case scenario if you don't file the election form. Okay, so get in touch with us. We'll let you know how to do it properly so that you can transfer the assets of your business tax efficiently to a corporation. Okay. Let's see. So I have one here that says, is the T22 valid for hybrid workers? Maybe you can take that.
Yes. If we're claiming, you have to have the T2200 to support it, because CRA do come back and ask for it sometimes.
That's right. So if you're partly working from home, working in the office, you're in a hybrid situation where you have to work, so long as you have that agreement with your employer and they give you that form, the T2200, then yes, you can certainly claim that. I know some employers do give a refund directly to employees. In some cases, you may not be able to, they may not give you a T2200. But if they do, then you may be able to write off a few things in your tax return. Okay, any more questions?
The only other addition to the question you answered first about the purchase of his first home is that when he sells the home, sometimes what taxpayers tend to do is forget to report the sale, even though he may get the the credit, the exemption from the, I'm sorry, what do you call it again?
The principal residence exemption.
The person, yeah, even though you may get a pre-exemption, some people forgot to report the sale, but you have to report the sale. It's required by CRA.
That is true. And that is a fairly new requirement. It just came in a few years ago. If you sell your property, your principal residence, there is now the requirement where you have to report it on your tax return. We know you don't pay taxes because you have the principal residence exemption, but you still have to report it on your tax returns. Okay, any other
And
final
if you
comments?
sell that home in less than a year, they will consider it business income as well.
Sorry, say that again.
And if he sells that home in less than a year, in less than 365 days, then they'll
that's
see
right.
that as business income.
That's
You
right.
won't
That's
get
right.
a free.
That's right. Okay, all right. So thank you so much for joining us. So we're going to end the presentation here. Obviously, you have our contact information. So for those of you that registered for this presentation or for this webinar, I'm going to send an email with the slides so that you have copies of the slides. You have those links that you can check out. Remember, if you want to engage our services, reach out to me if you want to take advantage of our 2025 rates. send an email to me before Monday, so that way I can honor those rates for you. Okay, all right, so bye everyone.